Let's go to Derek Holt. Derek Holt, of course, is Vice President and Head of Capital Markets Economics at Bank of Nova Scotia. Derek, thanks as always for joining us. It's a big, big week for people in your world. We've got U.S. inflation numbers coming on Thursday. For the 2 days prior to that, Tuesday and Wednesday, we get testimony from Jerome Powell of the U.S. Fed on Capitol Hill. Let's start with the inflation numbers. The consensus call from economists, as surveyed by Bloomberg, is an annual pace of inflation of 3.1% in June. That would be down from 3.3% in May. What are you expecting? What are some of the numbers beneath the headlines that you'll be watching very closely?
Sure. Okay, Paul. I think the key number here will be core inflation on a month-over-month basis, and that is the U.S. traditional measure excluding food and energy. Consensus expects that to be up maybe a couple of tenths after we had a soft prior month reading of about 0.16% month-over-month, so rounds up to 0.2. Another soft print could be welcomed by markets in terms of pricing rate cuts by the Federal Reserve. I'm a little bit more cautious. I think we could see a little bit of a rebound this time around. I'd welcome a soft print, but the reason why I'm cautious is that the core services gauge that excludes energy services as well as all of the housing measures was the main driver of the prior month's softness. And usually when that happens, the next month is an up month, and going back across all months in history, except for the very early stages of the pandemic. And secondly, I think that core services measure is particularly linked to measures like wages that are the biggest cost component in the delivery of a lot of those services, ex-energy services and ex-housing. And wage growth in the United States is still quite strong. So I went with 0.3% month over month with upside risk. And I think the Fed is going to be very cautious if they see a print like that.
What are you expecting in gasoline prices and shelter prices, which have been a major factor here in Canada in inflation?
I think you hit the nail on the head in terms of the other key driver here, the shelter category. It's been stubbornly sticky for an extended period of time. It's not showing the disinflationary pattern that we might have expected to date in terms of linking it with market rents and gauges of what's going on in that sense. And so that's about 36% of the US CPI basket, that if it still posts another 0.4 or 0.5% month over month, non-annualized seasonally adjusted gain, then you'd add that on to the possibility that core services inflation comes in relatively warmer again. And so you've got 60% of the US CPI basket, 1 quarter weighting on core services, 36% on shelter, that could be quite warm at the margin. And I think that would be a bit disconcerting to the Federal Reserve.
And Jerome Powell speaks tomorrow and Wednesday to committees on Capitol Hill, congressional committees. In some notes, you refer to his testimony perhaps stale on arrival, as he will speak 2 days before and 1 day before these crucial numbers are released.
I don't expect much from his testimony. I mean, there's always the possibility of surprise, but he's spoken a fair bit of late, and he's basically laid the script for us into the July meeting, but also into the September meeting. The Fed has seen some evidence that it likes, but it's not seen enough of it. It wants to see more of it before it decides on key issues like when to start guiding a rate cut. And I think they're going to take the summer off in that sense. We'll see them back at Jackson Hole at the end of August, and then maybe they prime things for September, but that's all very contingent upon what happens to the summertime data between now and then. And so I think he's probably going to toe the line in terms of being consistent with his other comments of late.
And so with all of that in the hopper, what is your call? What is Scotiabank's call on what the Fed does and when?
Okay, Paul, sure. So we have a first cut from the Federal Reserve at the September meeting, and then another cut as we go forward by the end of the year. I don't think it's likely that they would cut at the November meeting. It's too close to the U.S. election, and they may wish to evaluate some of the uncertainties at that point in time. But we have 50 points in cuts from the Federal Reserve this year. And as we go off into next year, we have cumulative rate cuts from the Federal Reserve of about 150 basis points, so 1.5% percentage points, ending next year at about 3.5% compared to the 5% policy rate right now. So material easing, but we're still a little bit concerned about the underlying inflation risk that is being maintained in the US economy. And so we're ending that forecast horizon at a little bit of a still restrictive stance by the Federal Reserve. Rate cuts, but still not as deeply as we might have had in past cycles.
In the political realm, the calls from within the Democratic Party, and it seems to be increasingly senior levels of the Democratic Party for President Joe Biden to either step aside or to make it a clear decision one way or another are growing louder and louder. How do you think financial markets would respond to a decision by Joe Biden to step aside and open the door to either Kamala Harris or another nominee?
That's a tricky call, to be honest. I think it partly depends upon who is the successor if Biden seems to step down. And so far, he's showing no signs of having any openness to doing so. And so it really depends upon who steps forward. And from what I've seen, with the exception of the one person who says she doesn't even want the job, most of the other candidates don't seem to be polling any better against Trump. And so I think the markets would just look at that as moving the deck chairs around on the Titanic in a sense.